Let's talk about the debt engine they've got. It's pretty large. So operating cash flow doesn't fund the acquisitions. Debt and equity do. In 2025, Betting Spoons threw off $291 million of operating cash and spent $1.85 billion on investing, almost entirely acquisition. The $1.5 billion gap got plugged with $1.94 billion of financing. In Q1 of 2026, they deployed another $1.65 billion and raised $1.74 billion to do so. Across 2023 through Q1 2026, they put roughly $4.6 billion to work buying companies against a few $100 million a year of internally generated cash. The fuel is this stack of term loans. They tapped the term loan A market repeatedly. They added a $710 million facility in 2024, $925 and $350 in 2025. Two more, and I think these are euros, $476 million tranches. Then a fresh $950 million and $300 million in January. I'm not even going to read the rest. These folks got a lot of debt, but they have a lot of capacity, right? They have undrawn revolvers, which sounds like a weapon. So there's dry powder for the next deal. The cost of all that leverage is now compounding faster than the business. So I mentioned interest expense grew 337% in 2025. They paid $143 million in just interest expense and 382% year over year if you look at Q1 of 2026. They paid $93 million in interest expense in the first quarter. And that was against revenue growth of 95% and 132%. So 2025 interest ate 51% of operating income. Q1 of 2026, it ate 78% of operating income. Annualize that Q1 interest run rate, and you're looking at roughly $370 million of interest a year, a number that grows every time they sign another term loan to fund another acquisition, right? Double-edged sword. On the equity side, the capital came from a tight cap table, actually. The largest outside holder is Galileo Quattro, a Luxembourg vehicle alongside Bailey Gifford. I've heard of them. And a long tail of co-founders and early backers. So Goldman led the $710 million raise at $11.7 billion last October. That put some cash in the balance sheet. Let's talk about some red flags here. So they told the SEC their accounting controls have material weaknesses, multiple material weaknesses. The filing cites an absence of clearly defined structures and accountability, limited SEC reporting experience, insufficient SOX and GAAP expertise, lack of segregation of duties, and weak controls over journal entries across all financial statements. By the way, they explicitly say the acquisition-driven strategy and constant integration of new businesses increased the complexity and contributed to the weaknesses. So their unaudited Q1 statements were filed as, quote, restated. So for like a company whose entire model is buying and consolidating other companies in their books, they're saying we can't reliably consolidate the books. That isn't a small disclosure. So safe to say they won't be acquiring any accounting software soon. Maybe they should. Maybe they should. Next potential red flag, the pro forma combined numbers come with a confession. So to show you what the portfolio looks like with AOL, Eventbrite, and Vimeo fully baked in, they built unaudited pro forma combined financials. And they wrote out loud that this information does not reflect our actual results of operations or financial condition and is not representative of our future results. What? Number 3, App Store dependency. A meaningful slice of distribution, marketing, and payment collection runs through Apple and Google, who take that 15 to 30% VIG and can change the rules whenever they like. Number 4, no long-term customer contracts. They generally don't have them. This is a subscription business that mostly bills month to month and consumer to consumer. The 8-year average subscriber tenure is reassuring, but there's no contractual lock in holding it there. Loyalty here is habit and brand affinity. It is not papered. It is not a contract. Number 5, foreign private issuer status. So Betting Spoons will report as an FPI, which means less frequent and less extensive disclosure than a domestic U.S. company, plus the ability to follow Italian home country governance instead of certain NASDAQ standards. For all our governance fans, if you take a step back, you're buying a foreign issuer with lighter reporting obligations and a founder-controlled board. Oh, number 6, they've never sold anything. I said that before, but the model assumes permanent ownership of every asset, which is like elegant when the assets keep compounding, but it's also terrifying if a few of them turn out to be melting ice cubes that AI accelerates. So there's no exit value in the strategy, which means impairments, not divestitures, are how a bad deal eventually catalyzes. Is this a compounding machine or a spaceship of tech debt? The honest answer is you won't know for a few years, and neither will they. Let's talk about their cap table. Who owns what? Well, the 4 co-founders keep control through that dual class structure. Class A shares carry 5 votes each and are held by CEO Luca Ferrari, Matteo Danelli, Francesco Patronello, and Luca Quarella. Ordinary shares, what you would get 1 vote. So same setup as most founder-led tech IPOs. Public investors get the economics, but the founders keep the wheel. The board has a name that should matter to its audience. There's someone named Robert J. Mylod Jr. who sits on it. He's actually the chairman of Booking Holdings, and it's former CFO. We like that. If you want to signal that someone who has actually run public company finance at scale looked at this thing and was willing to put his name on the cover, there it is. The rest of the board includes Coalition CEO Joshua Moda and a mix of operators and academics. The syndicate here is 14 banks deep. It's led by Goldman, lead left. Then they got JP Morgan and stocked with European houses like Unicredit, Intesa Sanpaolo, and BNP Paribas, a roll-up with a continental badge, right on brand. How much is this thing worth? Valuing Bending Spoons is hard for the reason that every conglomerate is hard to value. It's a sum of the parts. You'd value Evernote like a sticky productivity SaaS business. You'd value AOL like a melting but cash-generating portal, Rimini like a volatile consumer app, and the whole thing like a leverage compounder. But nobody values Berkshire by slapping one multiple on it. Nobody should value this on one multiple either. But the parts you'd normally guess at are unusually visible here. We know the revenue is 84% subscription. We know blended NRR is 94%. We know organic growth is 13%. We know the adjusted operating margin is 47% climbing. So the sum of the parts is hard, but it's like not completely a black box. And the reported target is roughly 20 billion. So against 4.36 billion of debt and 741 million of cash, that is about 23.6 billion of enterprise value. So on that basis, if you took their 2025 revenue of 1.31, that would be 18x forward revenue. If you took their TTM revenue of 1.6, it would be 15x. If you want to look at this on an adjusted EBITDA basis, maybe we should have been doing that all along. The CEO is guided to 1.4 billion of adjusted EBITDA in 2026, up from a reported 700 million in 2025, which pencils to roughly 14 to 17x EBITDA. Here's where you have to decide what you're buying. At 14 to 17x forward adjusted, I said adjusted EBITDA, you're paying a premium roll-up multiple. Constellation Software is the gold standard of software acquirers and the only true comparable public name. And it trades richer than that. So the bulls will tell you that Bending Spoons is actually cheap relative to the best in show competitor. The bears would tell you that Constellation earns its multiple on decades and decades of never overpaying and never blowing up the balance sheet. And Bending Spoons is 13% organic growth, a 100% effective tax rate last year, 4.4 billion of fast-growing debt, material weaknesses in its controls, and a habit of adding back the cost of its own business model to get that EBITDA figure. Okay, so what you're actually pricing at 20 billion is a bet that the operating machine is real. Evernote says, yeah, that AI keeps widening the productivity edge. The pull request data said maybe, and that the next 50 acquisitions are as good as the first 50 before the interest expense catches the earnings, right? That's the cat and mouse game here. And it's also a bet on Luca Ferrari being Henry Singleton. And Singleton was a real outlier. The base rate on this serial acquirer is the next Teledyne is not great, but it is also not impossible. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations. Woo! Everything a scaling company needs. They've got 5.0 star, 50, wow, 50 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me.